Investors, welcome to Stock AI Insights. This is Earnings Analysis. I'm your AI analyst.
Now remember, this content is for educational purposes only and does not constitute investment advice. Investing does involve risk. Today, we are breaking down Disney's Q4 2025 earnings, which were released on November 13, 2025.
So what's the real story this quarter? Well, a quote from CEO Bob Iger really sets the stage. He said, "Our streaming business, just 3 years ago, our DTC business was running a $4 billion operating loss." Think about that for a second. A $4 billion loss. That context is absolutely essential to understanding the numbers we're about to jump into.
Okay, so here's how we're going to break it all down for you. We'll start with their top-line revenue. Then we'll do a deep dive into profitability. And we'll wrap it all up by looking at their guidance and what they see coming down the pike.
All right, let's kick things off with revenue. You know, the headline number is one thing, but it can be a little misleading. To really understand what happened, you've got to peel back the layers and see how each part of the business actually did.
So, the big number for Q4 revenue was $22.5 billion. And while that sounds massive, what's really interesting is that it was basically flat compared to last year. It also came in just a little shy of the Wall Street consensus, which was looking for about $22.8 billion.
And if you look at this chart, you can really see why. It was a totally mixed bag. On one hand, you have this huge bright spot, the experiences segment. That's the parks and cruises, which saw revenue climb a healthy 6%. But on the other side of the coin, the entertainment segment's revenue actually fell by 6%, and that really pulled the whole number down.
So, what's the deal with that drop in entertainment? Well, a huge part of it comes down to a really tough comparison for the film studio. I mean, the same quarter last year had absolute monster hits like Inside Out 2 and Deadpool and Wolverine. This year's slate just couldn't live up to that incredibly high bar, and you can see that pressure reflected in the numbers.
Okay, so that's the top line. Now, let's talk about the bottom line, profitability. And honestly, this is where the picture gets even more complex. It's almost like you're looking at two totally different Disneys operating under the same roof.
Okay, check this out. We've got two key earnings per share, or EPS figures here. The official GAAP number was 73 cents, which is a massive increase, more than 100% from last year. But the adjusted EPS, which is what analysts really watch for core performance, actually dipped by 3%. That kind of gap tells you we've got to dig deeper to see where the money is really being made.
This chart breaks it down for us perfectly. You can see experiences leading the charge with almost $2 billion in operating income. But then, wow, look at entertainment. Its operating income dropped a steep 35%. So it wasn't just a revenue problem for that segment. The hit to its profitability was even bigger.
But, and this is a really big but, while that was happening, Disney's other growth engines were firing on all cylinders. The experiences segment didn't just do well, it delivered a record Q4 operating income, up 13%. And, circling back to that Iger quote, the streaming business, its operating income surged an incredible 39%. This is that streaming cash engine that investors have been waiting for.
And it's not just us saying it, Wall Street is definitely taking notice. As one Morgan Stanley analyst put it, the sustained improvement in streaming profitability is a critical proof point for Disney's long-term strategy. This pivot from huge losses to real growing profits in streaming is arguably the single most important story of the quarter.
All right, so that's the look back. What about the look forward? This brings us to our final section, the company's guidance and outlook. And let me tell you, management is sounding pretty confident about the year ahead.
The big headline guidance is this. Management is forecasting double-digit growth in adjusted earnings per share for fiscal 2026. That's a bold call, and it signals a strong belief that their growth areas are going to more than carry the weight.
And let's get into the nitty-gritty with this table. Beyond that EPS growth, they're planning to double their share repurchase program to $7 billion and boost the annual dividend by 50%. They're also projecting continued strong profit growth from experiences and, crucially, they're guiding for a rebound to double-digit growth in the entertainment segment.
Bob Iger himself connected the dots on the earnings call. He basically said that this expected growth is what's allowing them to both continue investing in the business and dramatically increase the capital they return to shareholders. The message is pretty clear. They believe their financial footing is getting much, much stronger. Now, of course, analysts are paid to add a little dose of reality. And while the guidance is robust, the consensus on the street is that it all boils down to one word: execution.
Hitting these ambitious targets is going to hinge on their ability to revitalize that entertainment segment, especially the film studio. All eyes are on them.
Okay, let's bring it all together. After digging through all the numbers, what's the final verdict on Disney's quarter?
Here's the final analysis verdict. Disney's Q4 was a story of transition. You had some real weakness in the legacy media business, but that was offset by a record-setting performance in parks and a really promising leap forward in streaming profitability. And all of that is sitting on top of a very bullish forecast for the year ahead. So what do you think? Can the magic return to the film studio to match the strength we're seeing elsewhere? Drop a 1 in the comments. See you in the next earnings breakdown.